Hello everybody, how you guys doing? Welcome to Finance 101. Today's topic we're going to talk about is debt management. Brought to you by myself, Mr. Finance, your favorite financial educator. You know, the number to always call me at is 973-873-5977. Once again, my number is 973-873-5977 for all your financial understanding and to also book your free financial checkup. Now, with that said, welcome to another great segment with myself here talking about debt management today. Now, one of the things that we gotta understand is that if we don't get out of debt, we can't take control of our future. If there's always debt, there's always obstacles. No matter how much you make, you're always gonna have to be owing someone. And the thing is to get out of the game of IOUs, right? I always have a saying that cash is king no matter what. Right? That's why one of the things that I always tell people, don't always aim to build credit, but aim to build wealth. So let's get into it, right? You got to control your debt or your debt will control you. Consider this. Say you have a credit card balance of $5,000 with an 18% interest. If you pay $200 per month, minimum 4%, it will take you 32 months or almost 3 years to pay it off. And that assumes you don't add more debt to it, right? So how many credit cards do you have? What about mortgages, student loans, car loans, and personal loans? Once you get yourself in debt, it will be hard to get out. Some people never escape, and that's the issue today. Debt can turn into a disease. It could control your life, diminish your happiness, and limit your freedom. So getting out of debt may be one of the hardest things to do, and it takes a lot of effort and time. But you must fight to do it. You can never be free until you are debt free. Don't get more debt. You got to live below your means, guys. You can't spend more than you make. Don't carry credit cards if that's the issue then. Use cash, debit, or prepaid credit cards so that way you can control how much amount of money you have on there. When using credit cards, you'll cut down your spending a lot, right? When you're using these type of credit cards. So in some situation where you have to use credit cards, such as buying an airline ticket, make sure you pay off the purchase right away when you get the bill. You should cut up all your credit cards except for one or two for convenience purposes, right? Don't carry a lot of credit cards. I know they look nice. I know they look beautiful, different colors. You can put your face on them, your favorite teams. But you got to live below your means and don't fall into that, because the interest rate that you're getting against you, if you follow this segment and you learned about the rule of 72, then you would understand why that goes against you, right? So spending money on things that are necessary is very important. And I mean, like, pay only for what is necessary, like food, the mortgage, insurance, and utilities, right? Cut out unnecessary spending like cable TV. And also getting these upgrades. I'm the guy that always hold my phone for years. I don't fall into that trend of upgrading. You can't catch me with that. If it can make a phone call and receive a text, I'm happy with it. Right? You don't need hundreds of channels, expensive gadgets, or excess cell phone data. There's no easy way. You have to give up something to get something. That's the only way you'll get wealthy, guys. You're not going to get wealthy overnight because you say, hey, I want to get wealthy. You got to get wealthy by making small sacrifices for bigger rewards later on. So you must make a list of all your debts, right? This is what I want you to do. Make a list of all your debts. Start to pay them off one at a time. You got to pick the easy, low balance debt first and eliminate it. Like timing bushes, right? It's like trimming bushes, sorry. Cut down one by one. That's how you got to deal with your debt. Because many of us fall into the trap where we always want to pay the big one off first. No, pay off the smallest debt first and then tackle the big one later. So what I'm going to teach you is something called debt roll-up, right? And just to give you a simple example, clear smaller debt first. Once smaller debt is cleared, you have extra money to increase the dollar amount on monthly payments for your bigger debts. Using the previous example, if you pay $300 instead of $200 per month, you can pay off your credit card balance in 20 months instead of 32 months. And the example that I'm talking about is the one that we mentioned, $5,000 at a 18% interest rate, right? So if you just paid $100 more, that could save you actually 12 months of payments. That's money in your pocket. How about mortgage payments? If you have a 30-year mortgage at a 4.5% interest for $300,000, your monthly payments is roughly around $1,520.06. If you put an additional $500 into these payments, you could pay off your mortgage in 18 years and 2 months. How incredible is that? You would eliminate almost 12 years of debt. So when you get a raise, instead of celebrating your success with a nice car, use the extra cash to prepay your mortgage. You will get out of debt sooner and live a worry-free life. That's one of the things that we want to do. So one of the things that we always teach people about is the X-curve concept, right? If you understand what is the X-curve concept, you understand the reasons to build wealth and get out of debt. So now, building wealth with responsibility is by using the X-curve concept. It's a simple way to show the relationship between taking care of your responsibility and building your wealth. This concept theorizes that in general, a person's responsibility decrease and their wealth increase over time, right? So let me give you an example. We're going to talk about two different things. When you talk about the X-curve concept, we normally talk about generally less secure people when you first start. You have a lot of responsibility. And at the time, you're pretty young and you're taking care of your family. But as you generally get older, where you're taking care of your future, the wealth should grow and the responsibility should lower, so that way you could generally become more secure. Because the X-curve concept involves two curves that run opposite directions during your lifetime. So the wealth curve, when you're younger, you normally don't have money. You don't have a lot of it. Then you start to save and invest. As you build up your wealth, the wealth curve rise. Hopefully when you get older, you'll have enough money for retirement. The wealth curve is your investment curve, right? So now let's talk about the responsibility curve. However, when you're younger and start a new family, you have a high responsibilities. We're talking about children, the mortgage, college, universities, debts, and all these things. So one of the things that we always tell people to have in place is what's called income replacement, which is insurance, right? If something happened to you, God forbid. So you and your spouse are responsible for these obligations whether you live or die. Early on, the need for insurance protection is quite high. But as your children grow up, your mortgage mature, and you reduce your debt, your responsibility will decrease as well. So more wealth, less responsibility is what we're aiming to be, right? So assuming you have 2 kids, if something happens to you, your spouse may not be able to take care of them alone. Factor in the standard of living your debts, and saving goals, you figure out that you need $500,000 of protection, right? With $500,000 in protection, life insurance coverage, your spouse will be able to have enough income to raise their children in case you are gone. You always got to think like that. Because if you don't, you're preparing to fail. However, let's say you are a good saver. You build up your wealth rapidly. When you have $100,000 saved, you may not need $500,000 in insurance anymore. At that point, you only need $400,000 because if something happens, your spouse will have the $100,000 that you have already savings plus $400,000 in insurance, totaling $500,000. When you save $300,000, your protection need dropped to $200,000. And of course, when you reach $500,000 of savings or investments on hand money, you no longer need for protection, right? So over time, the goal is to build wealth and replace it with the insurance. But the best way, and I always tell people this, one of the greatest way to secure that you're going to have wealth immediately, I always ask the question, where can you pay $300 a month and immediately have access to $300,000 and more in value and wealth? Where else can you put your $300 and have immediate wealth? Where else? So if you apply this simple principle to your home, when you buy a house, your friend will come to your housewarming party and congratulate you, the new homeowner. But actually, you don't own the home. The bank lenders does. You own the mortgage, which is your responsibility until you pay it off. You don't own the home. Assuming your mortgage is $300,000 for 30 years, most of your payments in the early years will go towards the interest payments and little into the principal of the loan. Understanding the X-curve concept, you decide to pay more than the monthly payment in order to accelerate your contribution to the principal of the loan. The faster you do that, the sooner you will be able to reduce your mortgage balance and you can own your home sooner than scheduled. Right? That's the goal. If we just understand these principles and apply these concepts, we won't ever be in debt no more. Right? So the X curve for the responsibility is something that we must understand. The X curve for building wealth is something that we must understand. And if we don't understand these, we're not going to get the financial freedom that we truly understand. We're never going to get the financial freedom that we even want. And we'll forever live in poverty. So, thank you guys for definitely tuning in. This one is a very short one. The next segment we're going to talk about is insurance or investments. We're going to talk more about that, and we're going to break down how the two difference work. And at the end of that segment, you will definitely know how can that benefit you. So definitely tune in next time. So our next segment, we're going to talk about insurance or investments. My name is Mr. Finance. Thank you for always tuning in. I look forward to talking to you guys soon again and sharing the knowledge. You know, it's very important that we always share this. So remember to always pass this on to a friend. Remember, you're just one decision away from changing your future for the better. Thank you. You have a wonderful day. God bless you all.